This is Justin CCS with Stock Talk Today. In today's job market, where unemployment is nearing all-time lows, the idea of finding consistent part-time work has become more accessible than ever. However, even with all sorts of job availability, bridging the gap between employers and employees has always been a historically unique challenge in the gig economy. Few are taking on this challenge better than ShiftPixy. ShiftPixy is currently trading on the NASDAQ with the ticker PIXY, Pixy, and the company operates as a disruptive workforce engagement platform provider. Pixy stock has shown tremendous upside potential in recent months, and joining us today to talk about it is President, Chairman, and CEO of ShiftPixy, Scott Absher. Scott, how are you doing today?
Doing well, Justin. Thank you for having me.
Great. Yeah. So I think it'd be great if we started off with the company's story, because to me, it's kind of unique. And then like, how do you find yourself basically doing this for so long? And also talk about the team behind ShiftPixy.
Sure. Yeah, Justin, when I try to explain our story, it really starts back in November of 2008 when the markets crashed on Wall Street. One of the things that emerged from that crash was massive unemployment. But the thing that struck me at that time was there was a new category of employment that the Department of Labor talked about, and they called it underemployed. And that number was 8 million lives, 8 million people were underemployed, meaning their full-time position had crushed down, hours had shrunk, projects got dismissed. And in that whole category of underemployed, the Department of Labor had never used that term before. But what most people don't, they remember well that crash, but what they don't pay attention to is a few short months later, in March of 2009, Uber was born. And when Uber came into that perfect storm, can you imagine now, instead of having to reconstruct your income by working restaurants, retail, or tending bar on the weekends or at night, now people can reconstruct their income just by flipping on their phone. As soon as that happened, as soon as Uber was born, the rules completely changed, the markets completely changed around part-time labor. And so we saw that begin to affect the part-time labor-driven markets in the country. Specifically, we look at that market as 28 million people the Department of Labor tracks as being part-time workers. Half of those are in the restaurant and hospitality industry, so 14 million. And one of the things that we saw as a result of Uber's advent was a dramatic increase in turnover. Historically, those part-time labor markets saw a 100% turnover rate. And in our original DNA in business, we handled the HR stack for a lot of small mom and pop companies. And we stayed away from part-time labor markets specifically because of 100% turnover. And after the crash and the advent of Uber, those turnover rates more than doubled. Today, they're trending at 300 to 400%. The combination of all these gig platforms out there now have given people a lot more ease of engagement and a lot more choice on how they want to work part-time. So the traditional brick and mortar operators are really struggling to find and keep people.
Yeah, so I mean that really resonates with me well, because Uber definitely saved my butt a few years ago. Just being able to just turn on your phone and access that, and that's kind of similar to the idea of your app in general. But you kind of brushed up on the gig economy, basically this 28 some million people who do part-time work, kind of attach everything together, and you really, in order to understand ShiftPixy, you really got to understand that market, because it's so unique. It's not LinkedIn. No, I didn't have LinkedIn when I was doing Uber. You know.
No, it's not. It's traditionally the part-time labor markets were made up of people that are in transition, like when you're a student in high school or college, or you're between jobs, or you're semi-retired. That's usually the composition of the part-time labor force. But what's happened is with all these gig platforms, it's actually a lot easier for people to navigate that. So they can actually construct a full-time income with multiple part-time gigs instead of being stuck at one location. And one of the things that we did when we saw the advent of these platforms, they were decidedly non-compliant. And by that I mean, going back to our original DNA, we had handled the HR stack for a lot of these companies, which meant that all the compulsory employer side taxes, workers' compensation coverage in case they're hurt on the job, all the regulatory and demands of being an employer. We handled that for thousands of clients. And what we saw was that these gig platforms were decidedly not taking employer status, even though they curated the work, dispatched the work, and completed the transaction using people. It's absolutely work by definition from a legal standpoint and from a regulatory standpoint. So for the time being, a lot of them have been able to get by that, although the courts are challenging that now. But we saw an opportunity to take all that we've done in the compliance side of the business and distill it down to a gig type platform. And what we've done, we've taken a slightly different approach. What we've done is gone out to the operators. In our particular case, our first vertical that we're heavily focused on is the restaurant and hospitality trades. So we focus very heavily on multi-unit restaurant groups. And we engage at the operator level with the operator, take their employees onto our platform. They become our W-2 employees, then they're leased back to the operator.
Oh, okay. Yeah, that's actually really interesting. I was wondering how you guys were you guys are like the gold standard for compliance and everything. And I was wondering how that worked out on your app. So you do the W-2 through ShiftPixy?
That's correct. Yeah, they're all W-2 employees of ShiftPixy. That means all the employer side taxes are being paid. All their taxes are their employee taxes are being remitted. The workers' compensation coverage is intact in all 50 states. So if they're hurt, there's the coverage for that. So everything that's required from us on a statutory basis for being an employer, we do. And then the uniqueness of this too, because there are W-2 employees, it allows us on our platform to share them one operator to another, so they can migrate and move, much like a temporary staffing type of arrangement. So it's kind of a hybrid platform that we've built. And we call it an ecosystem just because of the sharing idea, the idea that one operator is sharing employees with another. And it's been really exciting to watch not just the restaurant operator community adapt to this, but we're watching now, there's other verticals that we're serving, like the temporary staffing industry is growing for us very quickly. We're one of those platforms that allow them to do a lot of things from an operational and growth standpoint that they can't do on their own.
Yeah, so I mean, just getting kind of into the functionality that you guys are reaching towards. You were also looking into delivery, part-time delivery work as well.
Yeah.
That's something new, right?
Yeah. You know what happened, Justin, is when we first set up the business, we started the company in June of 2015, and we brought our first client on in August of 15. And what we wanted to do as we were starting the business and building the business is we wanted to we attended a lot of restaurant and multi-unit operator conferences just to kind of listen to the chatter, not to really present ShiftPixy. We were still too new at that time, really to trying to confirm that our proposition was going to be beneficial to these operators. And we heard lots of stories about turnover and lots of chatter about how bad it's gotten. A lot of these operators know that even what it costs them per turn, most of them pegged at between $1,000 and $2,000 every time they have to replace somebody. So we knew we were on the right track. But we also knew why they were having this problem, that they were being disrupted by all these gig platforms. And the irony was, at all these conferences, we're hearing all about while we're getting confirmation that we're on the right track for curing turnover, at the same time, the same consultants and advisors and speakers were saying, you guys got to get on the bandwagon with third-party delivery. You got to make your deal with Uber Eats, Grubhub, DoorDash. Make your deal now, because all your peers are seeing 20 to 40% revenue growth from this. And I'm an old Chicago guy. I grew up with the McDonald's lore, and I remember how precious brand was to them. So I started asking some of our multi-unit clients, I said, please explain to me how it is that a brand that maybe has spent millions or billions of dollars in decades, even maybe generations, curating their brand and their customer experience, why in the world would they surrender their brand, their customer experience, and now their customer data to a kid in a red golf shirt and cap? I said, I don't get it. And as soon as we asked that question, all these operators started telling us stories about late food, no food, half-eaten food, all kinds of things that they were getting blamed for, and it was damaging their brand. So we knew that we could fix that for them. Because we were already embedded with them on the human capital side, working with them in the dailies, what we knew also, we're very good at micrometering commercial insurance coverages through our ecosystem. And we knew that the only thing that would separate a McDonald's, as an example, from, say, Domino's Pizza was that in the pizza business, just as sure as you're putting in pizza ovens to run your business, you're also buying a commercial insurance coverage called hired and non-owned auto coverage. And the purpose of that coverage is that when somebody leaves the shop with a pizza, goes to the customer, and then comes back to the shop, if there's an auto accident in that loop, the shop is liable for it. So there's a time-honored tradition for having that coverage in place, but there's also a formula for writing it because the underwriters know exactly what you're going to be doing. But that formula doesn't exist, and that opportunity doesn't exist for all the sandwich shops and all the other fast food industry, because there's no model for them. They don't deliver. So what we did is we went back to our commercial insurance roots, and we came up with a method that we could actually meter hired and non-owned auto coverage on a per trip basis. And what we did was we created a mechanism where they could assign two of their uniformed staff members on a shift, that anytime an online order came in, that uniformed staff member could pick up the order. They'd get a notification on their application, on our application platform, and they could take that order out to the customer. Now, what they're able to do in that type of a transaction is deliver with a uniformed staff member a brand-intended customer experience. So we started introducing that concept just recently to the restaurant community, and we were calling it self-delivery. In fact, we're also advertising in a lot of the restaurant publications about brand damage. And it's really interesting, the conversation that sparked. I speak frequently to analysts on Wall Street that cover the restaurant industry for the investor community, for a lot of the big investment banks. And we talk about those two things. Number one, toxic turnover, which we're curing, but also brand damage. And this idea of creating self-delivery. And it has created, what I tell people is we're kind of fishing with new bait. Our turnover cure was very popular, but now, again, just an extension of this ecosystem allowed us to help these folks cure brand damage.
Yeah, that's awesome, and your explanation just kind of rounded everything out for me, because I had some questions about these shifters, like were these your employees and stuff, and
right.
So who's responsible and all that stuff, and how everything works together, and that just kind of cleared everything up, and it just made it's like, oh, okay, so the onus is on basically you guys to ensure that everything works right, and if it doesn't, then you guys will make sure that that the person who's doing the actual delivery is reprimanded and everything's taken care of.
Right.
So so, and that kind of brings up the app in general. I was tinkering around with it yesterday just a little bit, and
were you able to get in?
Yeah, I was. Okay. And then I got stuck a email verification.
Oh yeah. So right now, the way the app works, and I think it's kind of confusing for people, because I do pay attention to some of the chatter that's out there. The way our system is set up now, we're not letting people that are not part of one of our operator clients come in the front door. So right now it's a closed community.
Okay, so that's actually really important. So for a couple of reasons. One, because I did get stuck at one point.
Yeah.
You jogged my memory. I was like, oh yeah. And then two, so what that basically means is that when you look at apps on the App Store, you want to see how many people are downloading the app, and that'll tell you how good the app is. Like,
right.
I launched an app a while back, and that was the whole thing. That is not the case with you guys, right? Because your guys are part of your company. They're not just these users, they're active members.
Right.
So I think you got like almost 10,000 shifters now. Is that
we're at about 10,000. That number will probably double come January, because we got a lot of new clients getting ready to board for January 1.
Speaking of doubling, I mean, like the last Q3 ending May 31st, that was sort of like what made me go, oh, this is a good company. Like you guys reported gross billings of 60.2 million, up 119%, exceeding estimates. Revenues doubled, 9.4 million versus I think 4.6 million last year, another 100% growth. Have you guys figured out, because you guys have been on NASDAQ for about a year and a half now, you guys figured it all out, and you guys are reporting great numbers, and everything's starting to shift higher, you know?
Yeah, it's been a wild ride. When we did our IPO in the end of June of last year, it was very interesting talking to the institutional investor community. We came up through Reg A Plus, which was really designed for early stage companies. And I think there was a lot of misunderstanding when we came out through this platform. Not just us, other Reg A Plus companies. They were all very early stage. And also, one of the things that didn't happen, which probably should have, there should have been some protections around small companies coming out like this. Specifically short selling, unfortunately. And so we got plagued by that, and it remains the case. But a lot of it was also due to the lack of visibility on our numbers. The normal data systems out there that populate the data on a public company, they were not set up to pick up data from a 1A filing, which was how we filed as a Reg A Plus. They were set up to harvest data from S1 filings. So there was a big, long months delay in getting data propagated correctly. And so there was a lot of confusion about what these companies were, and so you can understand why the short selling community would would make sport of them.
Yeah, the market is brand new pretty much, because it's basically the Uber market. It's like you have an Uber for landscaping now and all this stuff. And I could see shorters just kind of like chomping at the bit with those sort of companies, and then not realizing that they're actually bumping into a real legitimate company that is making exceedingly great gains. Just very quality stuff coming out, especially over the last 3 months. And I think that this is a good place to stop. And before, I could talk about this all day. Honestly, this is very your company in particular, very interesting. And it's in a unique market for me personally. But I think we could leave it at that. And on top of that, because you do have earnings coming out soon, so that's going to completely change the conversation. So I'd be excited to talk to you again after earnings.
I'm happy to talk to you. Yeah, and then also for any of your viewers, we're going to be putting up some explainer videos that'll actually walk people through a demonstration of the application and how users use it, because we know that people aren't able to see it right now. And I want to point out too that in the not too distant future, we will open that up for people to locally participate. Right now, we want to build enough job mass and opportunity mass before we open it up to the general public. A lot of those platforms, they don't work on the curation of jobs and opportunities before they open it up, and users get disappointed. So there's a time coming soon, especially in Southern California, where we've got enough mass and opportunity that outsiders will be able to come in and use the application.
Awesome. That's good to hear. Great. Is there anything else you want to talk about, Scott?
No. I'll save it for our next conversation.
I'm excited.
I'm anxious for our earnings to get out there too. It's going to be a lot of fun.
Yeah, a lot of people are looking forward to it, actually. So, all right, that sounds great. And I'm Justin CCS, and that was Scott Absher, President, Chairman, and CEO of ShiftPixy. And as always, make sure to do your own due diligence before investing, and have a great weekend, everybody.